let's say you have 10 staff that work with you or with your organization, and then you pay each staff 100,000 per annum for the sake of argument. So we have 100,000 times 10 staff per annum. That will give you 1 million. Okay, so if, for instance, you did not pay up to 1 million by the end of the year, say you paid 800,000, okay, and that means that you were still owing your staff salary to the tune of 200,000. Now, in such a scenario, what we do is to adjust for the owings, or to adjust for the arrears of salaries that is yet to be paid. So this will take us to adjusting for accruals in final accounts. Accruals are dues yet to be paid or received. They are also called payments in arrears, or you can refer to them as owings. Now, what I am saying here is that in a business organization, it is possible to have enjoyed a particular service, but the payment not made as at when due. It is also possible to have earned a particular income, but the cash not received as at when due. Whenever you have this kind of scenario, we refer to them as accruals. So it means that accruals can either be in the form of expenses accrued or incomes accrued. Now, let's look at accrued expenses. Accrued expenses are expenses incurred but not yet paid for. Let's say, for instance, you entered a vehicle, that is transportation, okay, from a particular point to another point. As at the moment you got to your destination, the transport fare is due to be paid. Now let's assume that the transport fare was not paid. Now what we are saying is that the expense has been incurred because the transporter has taken you to your destination, but you have not yet paid for the transport. Such is called accrued expense. We can also call it expenses in arrears. We can say expenses outstanding. We can say expense owings. You see, for instance, you paid for rent for 6 months instead of for 12 months. So it means that the first 6 months that you paid for is what you have enjoyed, together with the last 6 months that you are yet to pay for. So it means that the last 6 months is the rent that is in arrears or accrued. Instead of you paying for a year, you paid for 6 months and you have enjoyed for a year. So it means that what? Expense in terms of rent for the last 6 months is what is accrued or is in arrears. So what I'm saying is, whenever there's an expense that has been incurred but payment has not been made, we refer to it as accrued expenses. Now we can have accrued expense at the beginning of the year. Remember I told you, I said the beginning of a particular year can as well be the end of the previous year. So when you have accrued expenses at the beginning of an accounting year or the end of the previous year, your adjustment is to deduct the accrued amount at the beginning of the year from the value that is what charged for the current year, or the value paid for the current year. Let's say, for instance, a payment for rent in the current year amounting to 100,000 has been paid, and they're not telling you that there's an accrued rent reported in the previous year as 8,000. Now, I've said that what you do when you have accruals at the beginning of the year is to deduct from the amount paid paid during the year. So it means that what you're going to charge to the income and expenditure, or your profit and loss for the year, is 100,000 minus what? 8,000, and that is 92,000. Now, this is how it looks like. We already said there was a payment for rent in the current year to the tune of 100,000, and they told us that there is an accrued rent reported in the beginning of the year, in the previous year, to be 8,000, but there's none in the current year. So you can see the rent account here. So we say accrued rent at start or beginning, 8,000. You see? Then we say cash paid for rent, 100,000. So we're taking out. So the difference is what is going to profit and loss, 92,000. So you can say profit and loss extract here. Total expense, rent, 92,000. Now we have accrued expense at the end of the year. Now what we're saying here is that you are adjusting for, an accrued expense due in that year of reporting. So what you do is to add the value to the current year charge. Okay? And now the amount you're adding to the current year charge is treated as a current liability in the statement of financial position or in your balance sheet. Why? Remember, we are saying that the expense is accrued. It means that you have enjoyed the service but you have not paid. So it means that you are owing the person that rendered the service to you. And remember, when you're owing someone, that person is seen as what? As a creditor. And creditors are current liabilities in the financial position, instead of financial position, or in the balance sheet. That is why your accrued expense at the end of a reporting period is treated as what? A current liability. Now we're taking an illustration. We say, for instance, a payment for rent in the current year amounting to what? 108,000. And an accrued rent reported in the previous year as 8,000. And I say, assuming that the current year accrued rent is 2,000, the total amount to be charged to the income statement in the current year will be what? 102,000. Remember, I told you that accrued expense at the beginning of the year is what? Deducted. At the end of the year is what? Added. So when you add 8,000 to 108,000 and then take out 2,000, or rather, when you minus 8,000 from 108,000 and then add what? 2,000, you have 102,000. That is what you charge to your profit and loss account. What I'm saying here, look at it here. We have accrued rent at the beginning of the year. That's 8,000. Remember, I said accrued expense at the beginning of the year, you deduct. Now we have cash paid for insurance, 108,000. Accrued rent at the end of the year, you add. So you're putting the same place here. Okay, so 108 plus 2,000 minus what? 8,000. That gives us 102,000. That's what is going to what? Your profit and loss. So we have profit and loss extract here. We're using extract because it's the rough work. It's not a complete or a detailed P&L. So we have total expense. We have rent, 102,000. Now the accrued expense itself at the end of that current year is a liability. Why? Because that part, like I told you, you have enjoyed the service but you have not paid. So you are owing the person that rendered the service. That's why it is now coming as a current liability in the balance sheet or in the statement of financial position. Accrued incomes. Now, an income is said to be accrued when it has been earned for the period but payment has not been received. Say, for instance, you render the service to a client. It is expected that the client should pay us, but if you have not received the payment, it becomes an accrued income. And it's a commission that you get on a particular transaction, but if as at the time you're reporting you are due for the commission but you have not received the commission, that is said to be an accrued income. In the same vein, accrued incomes at the beginning of the accounting year or at the end of the previous year is adjusted by subtracting the value, okay, from the amount treated as being earned for the current year. So what I'm saying is, when you have accrued income at the beginning of the year, you subtract it from any amount received during the year. Now take for instance, cash received for commission in the current year amounting to 200,000 and an accrued commission reported in the previous year to be 10,000. Okay, I told you, I said accrued income at the beginning of the year or the end of the previous year is adjusted for by subtracting from the amount received during the year. Okay, so it means we're going to have 190,000 treated as what? Commission here. But let's see how it goes. This is how it is. We have commission received account here. So we have accrued commission at the beginning of the year, 10,000. Cash received for commission, 200,000. So the difference is what? 190,000. That's profit and loss account. You can see it here. Other income, commission received, 190,000. So basically, it's just applying the what? The rule. Now, accrued income at the end of the year is adjusted for by adding to the value of the current year income recognized. So, if for instance, we have, just like the former question, we have 200,000 received during the year, they're telling you that there's an accrued income at the end of the year to be maybe 50,000. What we are saying here is that what? We add it to that amount to get the actual amount to be treated in the what? Profit and loss what? Account. Now take for instance, we say cash received for the commission in the current year is 200,000, just like in the previous illustration. And accrued commission reported in the previous year, that's the beginning of the current year, 10,000. Remember these adjustments? Accrued incomes at the beginning of the year, you deduct. So we already have 200,000 minus 10,000. Now they are not saying, assuming that the current year accrued commission is what? 12,000. Okay? So remember I said at the end of the year, you what? You add. At the beginning of the year, you deduct. So it's 200,000 minus 10,000 plus what? 12,000. So let's see how it goes there. So we have commission received account here. Accrued commission at the beginning of the year is 10,000. Cash received for commission, 200,000. Accrued commission at the end of the year, 12,000. So 200,000 plus 12,000 minus 10,000 is 202,000. That is what is going to your what? Profit and loss account extract here. And remember, accrued incomes, it's going to be what? An asset. Why? You have rendered the service, but you have not yet received the payment. So the person to whom you have rendered the service to is owing the business. Remember, when someone is owing the business, that person is seen as what? As a debtor. Debtors are current what? Assets. That's why you have current assets here, accrued commission, 12,000. Now, this is an illustration. So from the following, you are required to prepare trading profit and loss account and balance sheet at 31st December 2018. So these are the questions. We have sales, land purchases, returns in what, carriage in what, rent, warehousing expenses, motor vehicle, equipment, bank loan, bank overdrafts, salaries and wages, capital, returns outward, accrued discount received 31st December 2017. We have discount received, discount allowed, opening stock, debtors, cash, creditors. So we have closing stock here. And then they're saying additional information. Prepaid rent as at 31st December 2018 is 25,000. We already explained how to treat prepayments. Okay, so we're going to apply that rule here. So if you have not seen the prepayment class, you can go to the YouTube channel. It's there, prepayment adjustment for prepaid income and prepaid expenses adjustments. Okay, that is the class. So get to know how it is being treated. So we have another additional information. We have accrued warehouse expense that affects December 2018 to be 25,000 as well. Then we have accrued discount received that affects December 2018 to be what? 30,000. So we're using this question to prepare the trading profit and loss account and the balance sheet. So we are already aware that the trading profit and loss account is also called the statement of financial the comprehensive income statement. Okay, so now we're preparing the trading profit and loss account or the comprehensive income statement. Okay, and then we are aware that from this question we're going to have a function of turnover, cost of goods sold, other income, and the total expense. And the notes here shows us how we got the figures that we are quoting for each item. For instance, this is turnover. This note shows us how we got this 380,000. So if we go to note 1, here's note 1. We have sales and returns inwards. So sales minus returns inwards will give us 380,000. The sales is 425,000 here from the question. Returns inwards is 45,000 from the question. So note 1, 425,000 minus 45,000 gives us 380,000. That's what you're quoting here. We already had a class on preparing trading profit and loss account and balance sheet. So I advise you to go back to that class and understand it in case you're finding it difficult to understand what we're saying here. There's a class on trading profit and loss account and balance sheet. So it's the same thing we're doing here, just that we are adding adjustments. Okay, so the next one here we say less cost of goods sold. Our cost of goods sold here is 283,000. So note 2 give us how we got it. So we have cost of goods sold here, note 2. Opening stock 30,000, purchases 240,000, carriage inwards 40,000, less return outwards 20,000. Whenever I see bracket like we're deducting. So everything gives us 290,000. Less closing stock 7,000. So that gives us 283,000. That's what you're having here. So you can confirm all this from the question. Opening stock 30,000. Look at it here. Where's the opening stock? We have opening stock of 30,000. Can you see? This is opening stock 30,000. So we have purchases. Yes, purchases 240,000. Carriage inwards. Yes, carriage inwards 40,000. Return outwards 20,000. Where is it? Is it returns outward 20,000. Closing stock. Okay, that's 7,000. That's what is in the question. So this is the closing stock of what? 7,000. Okay, the cost of goods sold here. The next one now, you know when you say turnover, so when you say turnover minus cost of goods sold, okay, that gives us the gross profit here, 97,000. So the next one is your what? Other income. That's note 3, 55,000. So we're going to go to note 3. Okay, so we have discount received as other income, but there's an adjustment. Now this is the adjustment. We have accrued discount received 31st December 2017, 20,000. Okay, then we have discount received to be 45,000. Then we now have accrued discount received 31st December 2018 to be what? 30,000. Remember, we established the fact that your accrued incomes, discount received here is an income. You know, at start, you deduct. At end, you add. So our discount received during the period is 45,000. Now we have discount received accrued as at 2017 ending, which is same as the beginning of 2018. And the rules say what? We subtract. So we're going to say 45,000 minus 20,000. Okay, so that gives us 25,000. Then we now have accrued discount received here at the end to be 30,000. That is to add. Okay, so 25,000 plus 30,000, that's what? 55,000. So that is what we are having here. Other income, note 3. Discount received 45,000 minus 20,000, which is the discount received accrued at what? Start. Plus 30,000 discount received accrued at end. That is what? 55,000. That's what we have here as what? Other income, 55,000. So if you add 55,000 to 97,000, you have 152,000. That's your gross what? Income. So we less our total expense. Okay, our total expense. So what make up our total expense now? We have rent, warehousing expense, salaries and wages, discount what? Allowed. All these are the expenses in the question. But remember, you can have as much expense as possible in the question, but you have to be able to identify which one, fits into your total expense or your total administrative expense or your overhead expense or indirect cost, depending on the question. Okay, but based on this question, we have 4 items: rent, warehouse expense, salaries and wages, and discount allowed. So you have to check, is there any additional information on these line items? The first one there is rent. So what's our rent here? We have rent here to be 58,000 based on the question. But there's an additional information. Prepaid rent as at 31st December 2018 is 25,000. The accounting year is 2018. So this is prepaid rent at end. Remember the rule. Prepaid expense at end is deducted. You can go back to the prepayment class for revision and then come back. So prepaid rent here is deducted. So we have rent here 58,000. There's a prepayment here to be what? 25,000. So for us to get the rent that will take to the P&L for that year, we're going to say what? 58,000 minus what? 25,000. That's what we're doing here. Rent 58,000 minus 25,000, that is 33,000. And remember, this 25,000, because it's at the end of the year, it has a balance sheet effect. It is prepaid. We have paid for the expense in advance. So it means that the person we paid to is owing the business. So that makes that person what? A debtor. And debtors are current what? Assets. Okay, so this your 25,000 will appear as a current asset item. We'll get there. So the next one is warehouse expense. Where's warehouse expense here? So we look for warehouse expense. So here we have warehouse expense. We have warehouse expense 35,000. Is there an additional information? Yes. Accrued warehouse expense 31st 2018 25,000. This is accrued expense at end. And accrued expense at end, the rule says we should what? Add. So there's no one at beginning, so we just do at end. So we have warehouse expense 35,000 plus 25,000. That's what? 60,000. And remember, the 25,000 here is owing because you have enjoyed it but you have not paid. So you are owing someone. That person is a creditor. Okay, and that's a liability. So this 25,000 will be what? A liability item. Okay, so the next one is salaries and wages. There's no adjustment, so we just pick 22,000 from the question. These salaries and wages, where is salaries and wages? We have 22,000. The next one is discount allowed. There's no adjustment to discount allowed, so pick it from the question. 25,000. So it means that all the total expenses, a combination of rent, warehouse expense, salaries and wages, discount allowed based on this question. So when you add everything, you have 140,000. That's what you have here as your total expense, 140,000. So when you minus total expense from your gross income, you have your net profit here to be 12,000. If your total expense is higher than your gross income, then you're going to have a net loss. But in this case, your gross income is higher than your what? Total expense. So you have what? A net profit. So that is it for the trading profit and loss. The next one is the balance sheet also called statement of financial position. And I told you the balance sheet is a statement that shows the assets of the business and the liabilities of the business. Assets are the resource or the properties owned by the business. Liabilities are what the business is owing others, including the owner of the business. Okay, so here we have the assets. What are the assets here? We have non-current assets. Non-current assets are more like fixed assets. Okay, fixed assets. There you have it. Non-current assets. The note 5. Land and building 230,000. Motor vehicle 325,000. Office equipment 250,000. These were all gotten from the question. Let's see the question. You can see your land and building here, 230,000. Motor vehicle is here, 325,000. Equipment is here, 250,000. So if we add land and building, motor vehicle and equipment, that gives a total of 805,000 for the non-current asset. So that's what we have. That's what we're quoting here, 805. In this question, there's no other asset, so that's why it is dash. Okay, so we have current assets, note 7. So we have note 7. What are the items there? Cash at hand is in the question. Debtors is in the question. Accrued discount received, that's the adjustment that we made for discount received. Remember I said accrued incomes at the end of a current year is a current asset, or at the end of the reporting year is a current asset. Okay, why? Because you have earned or you have rendered the service but you have not been paid. So the person that you render the service to that is here to pay you is owing you. That's a credit. That's a debtor. That's why it is here as a current asset. Here we have prepaid rent. Prepaid rent simply means that you have not enjoyed the rent but you have paid for it. So the landlord is owing the business. That is here as current asset. Okay. Closing stock unsold that's in the store at the end of the period. They are assets. So when you add all this together, you have 162,000. The cash at hand, debtors, closing stock, they are all in the question, including the discount received, prepaid rent, and the accrued discount received. They are all in the question. So you can check that out in the question. Okay. So we have cash, 45,000. We have debtors, okay, 55,000. So the prepaid rent is the additional information item. Accrued discount is also the additional information item. So here is it. This is the prepaid rent as at December 2018, 25,000. Okay, you can see it there. Prepaid rent as a current asset. Okay. The next one here, accrued discount received 2018, 30,000. You can see there too as a current asset. Why are they here? I've explained it before. I'll do it again. Prepaid rent. You have not enjoyed the rent but you have paid. That means that the landlord is owing the business. So that is an asset. Debtors are assets. Accrued discount received. You have earned the discount but you have not received it. Okay, so that means that the supplier that is supposed to give you discount is owing you for it. So that means that supplier becomes a debtor technically. So that's why it's a current asset. So for you to understand asset items, liability items, you can go to our class on double entry for assets and liabilities. Okay, so that's how we got the 162,000 you have here as current asset. So when you bring that here, so 162 plus 805 gives us 967,000. The next one now is our liability. So we have long-term liabilities. So that's the long-term liability. We have bank loan, 600,000. It's in the question. Here in the question, look at it. Bank loan, 600,000. Oh, picking the idea there. So that's the only long-term liability. You can have other liability items. Okay. So that's what you have here as long-term liability. Okay. The next is short-term liabilities. We have it as 175,000. The note here says note 9. So let's go to note 9. We have note 9, short-term liability. We have accrued warehouse expense. It's an additional information. Okay, 25,000. When something is accrued, it means you have enjoyed but you have not paid, so you're owing the person. So that's liability. Bank overdraft, creditors, they are all in the question. Accrued here is the additional information there that was adjusted for. Okay, so we have 175,000. That's what you have here. Short-term liability, 175,000. The next one is owner's equity, note 10. I already explained to you that your owner's equity is a function of what? The capital and any profit or loss made. So your capital can increase or decrease. If you make profit, it will increase. If you make loss, it will decrease. And if you withdraw anything for your personal use, it will affect it as well. But in this case, we have capital of 180,000 is in the question. Then the profit made 12,000. This profit here, 12,000. This is the capital, 180,000. So if you add 12,000 to 180,000, you have 192,000. There's no drawings. Drawings is when the owner of the business takes some items or cash for his personal use. 192,000. So that's what you have here. Equity 192,000. So if you add this to this, you have 967,000. Total liability is 967,000. Total assets is 967,000. That is your statement of financial position, showing your assets and your liabilities as at 31st December 2018. So this is a class on accruals, also called owings or arrears. So I will encourage you to go through it, and if you have questions, you can reach me on 08136506356. Send me an email, jeremiah.dosu@gmail.com. I'll drop questions in the comment section. I'll be there to reply you with the right answers.